Welcome to the third class of our course, the complete course on Indian stock market. And topic of the third class is how to not lose money in the stock market, or vice versa, why people lose money in the stock market. So we are going to learn few basic concepts as well, apart from knowing the root causes. And since this course is designed for everyone, for investors and people who are going to make their career into stock market, these basic understandings are very important. So in the first 12 topics, I'm gonna also keep introducing new concept of the market, which you might be aware or not aware even. So in today's class, apart from the experiences which I had after speaking to a lot of people, conducting a lot of webinar, that why they ended up losing money, those tips I'm gonna reveal you people, or those understanding which I have developed over last 15 years is something which I'm going to share. As I always say, this is not just a theoretical class. It's more like theory plus practical plus the experience we have, you know, done after giving a lot of webinars and conducting seminars, and also talking to a lot of investors and traders. We are going to basically club them all together and put it in a form of videos, and then later on also the exercises. So yes, two concepts we will learn today. One is called impact cost, and before even learning the impact cost, we will understand the order book mechanism. So what exactly is order book, and how order book function, or how order book get created. Lot of people who want to make career into algo trading kind of environment, for them also it's very important that they know this basic mechanism, basic flow of the order book. So order book is something which we will learn, and then we will come to different factors which actually are, you know, true for 95-96% of the cases. See, there is nothing you know, when we talk about experiences, they can be biased, you know, but top 5 reasons we have identified, and we are putting you into that perspective. If you want to challenge there, I'm more than happy to debate and more than happy to basically discuss, I would say, not debate, and listen to your opinion as well. People who are taking this course, I'm sure you are, you know, connected with me from one or the other medium. Either we know each other, or you are connected to me on LinkedIn, and even if not, you have my WhatsApp number, which is there on the website as well. So you can contact me there. I'm quite open, you know, discussing and taking the classes forward, taking feedback, even reshooting the classes. So if you feel that, you know, this class is not up to the mark, or something which we are looking for in this topic is not there, we can discuss and we can redo it also. I have no issues in that. I believe in constant improvement, and it I mean, constant improvement is required everywhere in every field, you know. So yeah, let's start with the topic. And to explain you the order book, why not we go and open NSE website. So in the beginning also, I told you people will be using NSE extensively, because anyway you are going to use NSE a lot, because 97-98% of the volume happen there. There's no as such big cost involved in you know, NSE, where you will not go to NSE and go and trade in BSE. So this course, you will explore a lot NSE website. So what I did that, let me walk you through. We will go to www.nseindia.com. I think last time I told you people about screener.in. This time let's talk about NSE website. So in NSE website, if you go, here is the live market. In live market, you can go to equity stocks. You can see Nifty 50 is there. So Nifty 50 is top Nifty 50 companies. A lot to do with this impact cost with Nifty 50 also. So there is a eligibility criteria to come to Nifty 50. So lot of people know that Nifty 50 constitutes good companies, big companies, widely held companies among investors from the Indian stock market. But yes, to include here, they have made certain criteria also, and one of the criteria is basically impact cost. So that's why also it is important to learn about impact cost. Okay, so this is Nifty 50 stocks. I can pick up any stock basically. Let's say we are picking IOC. Well, the market, so right now when I'm recording this video, this is 5:30 p.m. Market is closed, and it's if market would have been open, you would have seen this is called order book, and what you would have seen is basically top 5 buyer and top 5 sellers are there. So is it actually 5 buyers or 5 sellers, or five or 5 top prices which has been grouped by buyers? So to explain this, let me give you one example in Excel sheet. So what did you see here? Order book is having buy quantity, buy price, sell quantity, sell price. So I can write here buy quantity and buy price this side, here sell price and sell quantity. Now you can see that there is a quantity 600, and price is, let's say, 99, 98, 97, 96. Hypothetical number I am giving: 95, 600, 500, 700, 450, 340, and here the sale price will be something like 101, 102, or let's start with 100, 101, 102, 103, 104, and let's say sell quantity is more like same, or maybe 670, and some changes, so that okay. Now what you will not see here is this coming from one guy, or is this quantity coming from one guy? Well, the answer is there could be many buyers who are willing to sell at 99, and one of the buyer is having 100 quantity, another is having 200, 140, 160, and that's how probably with this 4 different buyers together want to sell 600 quantity, and they want to sell at 99. So they will be called the best buyers. Again, in this whole process, out of these 4 buyers, maybe this buyer was the first guy to place the order. If he would have placed his order first, and on the other side there would be one guy with 100 quantity and he is the first guy to sell, then these two people will get the preference. So their execution will happen the first if it is happening at the respective price of 99 buying or 100 selling. But what happened exactly is, let's say at this point of time, the last traded price. So last traded price is the price where buyer and seller both agreed. And let's say last price was 99.5. Well, this is the order book, I can tell you, okay, where you will see last trade price here and order book here on the NSE website, okay, but actually I have converted that into an Excel sheet, right? So 99.5 is the latest price. Obviously you will not see this kind of difference in a good liquid stock. I have just given it for a reference. So this could be 99, and then this could be even 98.9, and this could be even 100.1. But to simplify the explanation process, I have taken this number. Now what will happen? So in a very ideal world, a bargaining will happen. So a person who want to sell, he always want to sell at the best price, and the buyer who want to buy, he want to buy at the best price. So if this guy is adamant that he'll only sell at 100, he'll be there, and if this guy is there at 99 and he is also adamant he will not buy anything above 99, he'll be here. But let's say one guy jumps from here from 98 with 100 quantity, and he says I am ready to buy at 99.6. So he'll come in the order. Similarly, one guy jumped from here, or even this guy also agrees that okay fine, if I'm not getting 100, I'm ready to sell at 99.6. Well, at this point of time, if both of them agrees, accordingly they will get the preference. If they are the first person to offer this price 99.6, offer to either buy or offer to sell, the latest trade price will become 99.6, and that's how the whole day trading keep on happening, right? Now, you must be wondering that why I'm explaining you this. I know it could be a very basic concept for many people, but well, now we all know that how order book work. So what you see is basically price. You don't see how many people are ready to sell at that price, and it is not important also. I mean, it is not important from whom you are buying the shares. That on that mechanism only the latest exchange or the latest technology is working, because nobody is interested they are buying from whom. Unlike in the real world, well, you got the liquidity, you got what you are looking for, you wanted to buy, you bought, you wanted to sell, you got a buyer who is going to buy at your price. What you see is the top 5 prices, but there are obviously depth. So coming back to the Excel sheet, you will see that 5 prices they are showing on the order book, but there could be even 2000 people in the row with the different prices, people who are ready to bargain, who think like, okay, I want to sell at 107, and doesn't matter my price is 7% away, but if I get 7% hike today, I'll sell it, and that's why they are placing the order. Similarly, there could be a guy who think that, okay, I'm fine buying it at 94, doesn't matter what the price is going on, and for next 10 days, 15 days, I'll keep on punching the same price, and I'll buy it only at the 94. Well, when I'm explaining you this, don't you think you got an idea that there are people who could be very adamant at deciding their price, because they have done certain kind of valuation, they understand few things, and they think that, okay, this company ABC is good, but only if I get to buy at 94 rupee and not 99 rupee. If I get 5% cheaper, I have a feeling that in another 1 year, I'll be able to make 20-25% return. So instead of hurrying, I'll buy at 94 and I'll wait for the price. Well, I want to take pause for a minute and explain you here something. See, it is very important to find your price. It is even in real life, if you remember, if you go to a vegetable shop and if you find that potatoes are expensive there, the everybody is selling potatoes as 25 rupees, but this guy is asking 35 rupees, what do you do in general life? You don't want to feel cheated. You simply move to the next shop and bargain there and do the this thing. The similar thing has to happen. So life is very much life is not that complicated even in a stock market. If you are very much adamant that, okay, you are comfortable buying ABC only at certain price, you should not get into the rush. You should hold. And if you're not comfortable selling at certain price also, you should still hold, unless and until the basic fundamental theory uh, don't go against it. So sometimes what happens that you are there to make 50% return in a stock ABC. You waited for 2 years, 1.5 year. You got 30%, 40% return. Now one fine day you got to know that this company has not given the correct performance, or some issue related with the quality of the company or the company management has come out. So a case like Idea, okay, it was a good telecom player, one of the top 5, top 4 player, but if you know that there is a big blow which is going to come from Reliance Jio because of the pricing, and if people are talking not good thing about it because of the the severe competition it is going to face, at that point of time you do not have to wait. It's not like you have the like made it on a written on a rule that I'll not sell it before 200 rupees. No, that time you have to come out. If your conviction has gone, you have to come out. As simple as that. Well, similarly with the buying thing, if you think that the valuation is correct and you are very much sure that you want to buy 5% down or 6% down, or you will buy its competitor which is available at the better price, I think you should wait for that also. Stock market is not something which you have to do in hurry, and that's why I was explaining you this order book and impact cost, because I'm going to show you the implication of impact cost now. Well, as an investor, what you do, just think from a perspective. So just visualize, if you are an investor and you are very sure about what you want to do, what would you do? I'm sure what you would have thought is you would wait for your price. You will not just go and jump and try to grab at a price which is being offered in the market, right? 95% of the people who are directly involved into the stock market, they go and jump over the price. Well, what could be the implication of that is something we have to understand now. And that is one of the major reason also when people trade frequently, they lose money. Okay. So let's say the last traded price in this ideal scenario is 99.6. But what if you are a guy who is going to jump and buy? Well, in that case, you will buy at the price which is 100 rupees. You will buy at the seller price. And if you are a guy after 1 hour, let's say you are an intraday trader, after 1 hour you have to sell, and a similar situation is there, no price difference. It's just that neither it has gone in your favor nor it is in your favor, the trade. Where do you sell? But then you have decided to buy, and that's why you bought at 100 rupees. And once you have decided to sell as an intraday trader, you will sell at 99 rupees. Now you can very easily see that there is a 1% costing which you have incurred. Well, you will say, Kundan, this example is not correct because this is not how order book look like, 99 and 100. Then I would say, what do you think how it should look like? So let's say it look like 99.9 and here 100. Well, even if there is a price gap of 10 paisa, the costing is 0.1%. So you are going to buy at 100 and ready to sell at 99.9. So 0.1% is something which you are going to take as a hit again. In the neutral situation where your trade has not gone wrong, it's just that you wanted to buy and now you wanted to exit and price is as it was, right? And now consider you make 5 such trade. Well, zero point 0.5 is the cost of the trade you are giving in a day. And if you are trading daily for next 20 days in a month, 10% is the impact cost you are taking on your fund. Well, till now, this is called the impact. So this is not the exact definition of the impact cost. I'll come to that as well, but for this simple example, you can see that if you are a frequent trader, be it you are a technical analysis trader, which is, again, I'm gonna in coming classes tell you that how difficult it is. There are very few players. I think in last class I told you also that only retail people have been pitched this technical analysis, because brokers have to give you alerts throughout the day so that you can trade and make a brokerage for them. So in this example, this is not, so impact cost is much higher than this 0.1%, by the way. Okay, the how I can tell you with one small fact. So the small fact is, forget about the 6,000 companies which are listed in India. Even for this Nifty 50 companies which are having huge market capitalization, the criteria to come into Nifty 50 is their impact cost per trade should be less than 0.5%. So if in last 90 days any company has traded in such a good liquidity, this is a good liquidity, okay, where the impact cost is 0.1%. Well, if one company has traded with 0.5% or less impact cost in last 90 days, they will be only eligible to come down to Nifty 50. So even in Nifty 50, the impact cost of a trade, one trade could go up to 0.5%. Well, the real formula to calculate the impact cost is where you go and take certain assumptions. So let's go back 99 and this is 100. Well, what could be the ideal price? Ideal price is when both of them move forward and they go and trade at 99.5. So 99.5 is the impact is the ideal price which it should be there. But let's say now you have a data where 99.5 should be the ideal price. But every time a buyer went to buy, and let's say he wanted to buy more quantity than which is offered by the sales guy, his complete fill can go to even 100 and above. So let's say you have 3000 quantity to buy, but seller is just 600. Then you will go and group all these quantities together and buy, and you will buy at different prices, and then the cost could be much higher of your trade if your trade is bigger. So in this case, the impact cost keep, so every time exchange is having these kind of pricing pattern and execution data coming, they keep calculating the impact cost. So how do they calculate is, if a pricing is something like that and the trade is happening anywhere above this or less, what, so let's say if trade happens like 100 rupees, then 100 minus 99.5 is the difference which has happened upon 100, and this will be your impact cost, 0.5%. So every time, if you're going to give extra price than the median price, that extra cost incurred to execute this trade successfully will be called the impact cost. See, as an investor, you do not have to go and even calculate this kind of impact cost, but something which you have to understand is a very basic fact, that if you are going and doing things in hurry, and if you are a buyer, you will end up buying at seller price, and if you are seller, you will sell end up selling at best buyer price. So you will always end up giving certain impact cost. It's okay, it's completely fine if you go and do this kind of execution once in a 1 year, 2 year, or 3 year. But let's say if you are a frequent trader, or even a active investor who keep doing it in every month or 2 month, or even once in a day or twice in a day, like a trader, trust me, you are gonna leak a lot of money in impact cost. People who trade these days algorithmically with good fast machine, the very first thing they try to cut out is basically how they can design those strategies where impact cost will come in their favor. Rather, you know impact cost will never come in their favor, obvious reason, but they will try to find those pattern where they will be always able to buy at their own negotiated price, and immediately try to become a seller where they will get the edge of those people who are always willing to go and jump at the prices rather than their own prices of the market, right? So impact cost is one concept which I wanted to tell you people, because in retail industry it is hardly discussed. But if you go and work in any big organization, and where you are going to basically have large executions, large trades to execute, impact cost is one of the costs which is even bigger than brokerage cost, government transaction cost, STT cost, SEBI charge, exchange turnover charge. All these things are minimal against the impact cost. This is something which I can tell you with my own experience. Well, now you understand impact cost, order book, and you have also heard about different kind of brokerage cost and transaction cost. You know that if you're going to do extensive trading, you have a very high chance of losing money if you're doing a manual trade. So even with our own experience with a lot of people who said that they lost money, trust me, out of those 10 people, 9 people were traders. So if you ever get excited by the word trading, just think about these costing and think about whether successfully you will be able to trade or not profitably. And to do this, as I keep saying, you have to go and test it on paper every time you are going to trade. I know impact cost of the things cannot be taken very precisely when you are trading on the paper, because market is dynamic. You will never get to know at what price you would have bought the share or sold the share unless and until you do it. But then there are simulators which test with the real market environment. And only if you are so tech savvy, then only you think about trading into the market. Otherwise, trading is a open gambling. Okay, and 10 out of 9, sorry, 995 out of 1000 people, I would say, they lose money in the market is because they are active trader with no knowledge, but trading has been pitched to them by the stockbroker. They open, so this is something which I want to discuss in more detail. See, the investment industry is working right now in India on a very different note. So consider you want to invest 5 lakh rupees. If you invest 5 lakh rupees and if you go and talk to your broker that how much money you want to give him as a brokerage, they can give you prices as low as 0.1%, the best of the brokers even. Okay, there are brokers who are discounted like Jirodha and many other discounted brokers who has come, but a lot of people face some issues with them. They want to stay with traditional one. I'm not promoting any broker, by the way, here in this class, but I'm telling you that brokerage costs have gone really low. So even if you invest 5 lakh rupees, this guy will be not able to make even 500 rupees for himself. And to make you invest 5 lakh rupees, he would have almost hunted you, called you many times, spoke to you many times, then convinced you about investing into the stock market. And after doing all these things, when you come and invest for 5 years, this guy really get disappointed. So every time they keep on pitching you to trade, they tell you that this stock is going really up, buy it, and suddenly they will turn around and say, no, 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 we got better opportunity, sell it, and you buy it that, and it has came because their technical team or the research team has given. Well, this is all done because you trade and they make money. That's their business model. Ideally the advisory and the broking business should be separate. Lot of lot of people have raised voice against this, that a broker should not be an advisor because it's a conflict of interest, right? This is the marriage of advisory and broking is a big conflict of interest from the consumer side. A customer will get advised many times just because broker has to make money. This is unfortunate that these two are not separate things. Otherwise, in ideal world, it should be separate things. SEBI must look into it, that he should instruct brokers to stop sending alerts, advisory alerts, intraday buy sell calls, and all those things. Well, coming back to the topic, if you really don't want to lose money in a stock market, try to become a value investor. I know making a very stern statement like this can put me on a spot from many people, but I'm not afraid, honestly speaking. I know this is the truth and I believe in it. This is again not a college class, and I can have a liberty to say all these things, that what I feel. And I strongly feel one of the biggest reason people lose money in the stock market is because they go and they trade without backtesting their strategy, and so much of cost is involved that even if they are executing 6 or 7 trades out of 10 trades profitably, they will still end up losing money in the market because of the heavy impact cost and heavy broking and other costs. Okay, so this is prime reason number one why people lose money. And if you don't want to lose money, this is what you have to care about. For people who come from trading background or algo trading background, for them, they know what I'm talking about, especially about backtesting this strategy. If you can backtest, yes, you go and trade, you bring the liquidity in the market, I have no issues. But trading on the tips of stockbrokers, trading on the tips of other people like tip sellers is something which is a malpractice. You should not get involved. You should stay safe, stay away from them. Well, there are many different reasons, other reasons also, which I'm going to discuss one by one. So this was the reason number one. You learned about impact cost, you learned about order book mechanism. Now the other malpractices are like, there are companies who says they are SEBI registered tip selling companies. Their business model is something which I have explained also. I'm going to attach that. video in the same course. After this video, you will see that you must see the modus operandi of such companies, that how they keep surviving and keep selling their tips and making money for themselves and looting customers. So you have to stay away from the tip sellers also. You need to learn some basics of the business, basics of the industry sectors, and identify how to basically, now that you have taken this course also, and if you finish this, I'm sure you will be strong enough to go and identify stocks yourself. You will develop a good knowledge about that there. Okay, so second thing is the tip selling thing. The other are, I have also included a Jaspal Bhatti video, which I included, I'm sure, before this video. That video was uploaded, so you would have seen how exactly people manipulate market also. So you have to stay away from manipulation and grapevine, and do not invest based on those grapevine as well. Well, there are many philosophical reason, or the reason which are theoretical, which I'm discussing with you. Apart from that, there are certainly some technical reason which is involved, where you can lose money in stock market as well. What could be those technical reasons? Let's discuss about them as well. Well, if the whole market falls and you have invested heavily, and you have invested recently, and you have not applied any kind of risk management, obviously you will lose money. Can the risk management be applied to safeguard the market risk? The answer is yes. We will cover this in the later chapter, which is future and options. Future and options are made to do the risk management. Risk management for specifically that risk which is called market risk. So when market will fall, your portfolio will come down, and if the same point of time you have to come out because you need fund, you will take a loss and you will come out. So there are two ways. If your portfolio is very heavy, you can hedge it by future and option instrument, and if you are investing slowly month by month, then that will be an opportunity for you, because market is gonna come up. We have seen it always, in the history. So that will be an opportunity. So we will learn about this in risk management, that how to manage your market risk so that you don't lose money in the market. That itself is a big half an hour chapter, so I'll cut it short here. Second risk is, some people, we have observed this trend, that they work in IT industry and they end up buying all the IT companies. They work in pharma company and they start with one pharma company and end up buying all the pharma company. And at certain point of time, one industry can specifically not perform well, even if the economy is performing well. Well, at that point of time also, you will end up losing money, because the more you are staying in market concentrated with just one kind of sector, it will become difficult for that sector to revive for maybe 1 year, 2 year, 3 year, and you will lose patience and you will sell the stock there. So this is called industry risk, which you need to manage as well. Where else you can lose the money? Well, if your portfolio is also concentrated to only one or two stock, then obviously, as I said, investing into stock market is about investing into businesses. Now one business can fail anytime, and at that point of time, if that company went bankrupt or the went into real trouble, and that any company can crash and come down to zero also, you have to believe in it. Simple. Any business can get shut. Any business can get shut. There's nothing wrong in that. This has happened. This may happen with me, this may happen with you also. Okay, so you have to trust in this, that one company may fail and you may lose all your money if you are just invested into one stock. So you have to diversify. You have to learn how to diversify, so that even if this kind of mishappenings happen with you, your portfolio will be still doing better than FD returns and all, if you have diversified it properly. So these are the technical reason why one person can lose money into the stock market. And there are there are obviously some fraud cases which can also happen. These days it's very rare, because SEBI and NSE, both of them have become very strict towards the leverage trading. So some time back, I heard still few brokers does it. What they do, that they do a lot of leverage trading. So more money you know, so they may have just 1 crore of money and they can go and leverage it and trade heavily in their own account, and one broker can go bankrupt also. And that point of time, even if you have not done any mistake, you may lose, you know, capital. So be sure that, you know, you are opening account with the right guy, right broker, and doing all the due diligence, asking everything about, you know, you know, the right practices. Best thing is, it's always better to go with top 10 people, you know, people. So I don't want to say that you do not have to give opportunity to the small people who are just coming as a broker, but then do the due diligence, try to stay with bigger names and don't go with the smaller broker. Okay, then also make sure that every transaction which is happening into your account, you are aware about it. These days brokers have to send a message and email, so any message which you think that is not correct, you should immediately report. You can complain to SEBI also. SEBI take a strict action. So stay away from the malpractices which are also there in market, and people may lose money there also. Well, this is all in the third class. Tomorrow we'll be covering another class, and for that we have to wait for another 24 hours. I mean, this is the format of this class where I'll keep recording one video and sharing it with you people.